Okay, fantastic. All right, so we are off and running. Hello, everyone. This is our September 29th, 2010 Forex training. It's in conjunction with FXDD and FX Street. Very excited to be here today. Our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. And so today's class on anticipating the Forex trends, this is going to be an exciting one, is when is it safe to trade against the trend? This is a question that many traders have. Greg will answer that today, and I think you're going to enjoy this presentation a lot. Now, if you haven't heard Greg before, he is the FXDD Vice President. He's the Chief Currency and Trading Analyst at the company. Many of you know him from his work there and also as a poster on FXStreet.com. Lots of positive comments on Greg. Myself, I'm Sean Powell, one of FXDD's national trainers. I will be along helping out, giving Greg questions, and also answering some of your questions in the chat as we're rolling along. We've got a contest going on now at FXDD. You can get all the details on our Red Bull Formula One pole position contest. All of that is available at FXDD.com. Every time our team wins or does well, we give you a bonus in your trading account. The other thing we're doing is a trading contest right now where you can win 2 passes to one of the next Formula One races, including $5,000 for travel and accommodations. This is exciting stuff. We were just in Singapore with a number of customers who won. You can get all the details at FXDD.com on our F1 mini site. Okay, so some housekeeping. We are doing the training today on Forex market analysis, trading strategies. We'll teach you how to find opportunities for yourself. Please participate, definitely. Participate, make it good by asking questions. Keep them on the Forex topic. You can also learn more about Greg Michalowski at blogs.fxstreet.com/fxtrader-link. That'll give you more on what Greg does on a daily basis for FX Street. Okay, so with that being said, Greg, if you're ready to go, I'm going to hand over the screen and the mic.
Okay. Hi, my name is Greg Michalowski, and I'd like to, like Sean said, thank you all for coming out here today for the webinar. I assume that people can see the screen. Hold on a second. Can you see the screen? I'm assuming that you can hear me too. So let's take care of those situations first. Get a positive from those people out there. Yes, and can you see the PowerPoint as well? Yes, perfect. Okay, all's good. All right, when it is safe to trade against the Forex trends? That's, so Sean's mentioned a question I get all the time. And for those people who have listened to my webinars here at Forex Street, I'm a big proponent of the trend is your friend. That was said many centuries ago, probably by some cavemen, perhaps, who were trading rocks and figured out what was the best rock to have in the cave amongst the clan there. But who knows where it was come, but it was centuries ago that some unknown trader, some unknown poet probably said the trend is your friend. Well, I like to say the counter trends can be friendly too, and that was by me, and I'm not a poet, and that was said here today on September 9th, 2010. There are opportunities in the market, folks, where you can actually trade against the trend and trade what I call the counter trend. A counter trend is, I'll define that in a little bit, but the reason why there are counter trends within the foreign exchange market is because changes in the Forex rate help correct economic cycles. So there is this potential for the foreign exchange rates to trend in one direction and then counter trend in another direction. In fact, that counter trend can actually turn into the trend at some point. But the reason, again, is that we have this mechanism within foreign exchange rates that allow economic cycles to move from being bearish perhaps to being less bearish or more bullish and vice versa. So if a currency is weak, it makes exports more competitive abroad. And if a currency is strong, it makes exports less competitive abroad. Therefore, the weak economy, the one with the weak currency, over time is going to get stronger. And the country with the strong currency, as we all know, one is weak and one is strong. There's no in between when you talk about a currency rate. When therefore the country with the weak gets stronger, and the strong economy ends up getting weaker. And so we have these cycles where you can have the dollar being sold off as we go through our banking and debt crisis here in the United States, and the euro can go, all the way up to 150, 160 area, and then you have the opposite where that transitions into the dollar getting strong and the euro getting weak, and it goes back and forth, and as a result, you get things like this. And this is a weekly chart of the euro versus U.S. dollar. You can see how the trend and this goes back to 2005. The trend is clearly in favor of the euro at this point, and then it becomes in disfavor, and the euro comes crashing down. We have this 1 or 2 month period where extraordinary period in 2008, December 2008, where the euro rallied up, I think, 22 big figures or so to the upside, and then you get the big crash to the downside, and then you have another trend to the upside and the trend to the downside here, which takes the euro from the 150, 144 level all the way down to 118.76, and now we are in this move to the upside. Is it a counter trend? Is the start of the trend back to the upside? Have we seen enough euro weakness and now going to get more strength? Who knows? We don't necessarily know, but what we do know is these counter trends, this move from 118.76 up to today's highs are significant. It's a significant move to the upside, and it is a counter trend, and is a trend that you as a trader should want to be part of. So that's the longer term picture. In the shorter term, we have trends of late have corrections as the ebbs and flows of the fundamentals and the technicals lead to more changes in direction as well. So although we may have that euro moving straight up on it, or moving up and down on the daily chart, we have an hourly chart here where we have the market moving higher, and then we have the market moving lower, and then we have this non-trending period where the market kind of corrects higher and corrects lower and then moves higher again. So we have these changes in trends all the time in the currency markets, and that makes it exciting. It makes it scary at times as well. It increases the, it's why people say the currency markets are volatile, but if you follow the tools, if you follow certain technical tools, and you determine the bias, whether the bias is bullish or bearish, you can follow these trends and actually take advantage of not only the major trends, but take advantage of the counter trends. Oops, skip the slide. So corrections in the forex market can again be counter trends, and as I mentioned earlier, they can also transition into a newer trend. And so, what is the definition of or at least my definition of a counter trend? And my definition of a counter trend is this: a counter trend is a move against the major trend that has the potential to be more substantial in terms of pips than a normal correction. So in this case, you'd expect to see moves that are going to be worthwhile to your trading. If you're talking about a daily chart and you have a trend, you can have counter trends that run 1,000 or more pips. That's what we've seen in this quote-unquote counter trend that some people think the euro has or is in at the moment. And if you look at the chart coming down from 151 down to the current level, we moved above the 50% retracement just recently. But some people may say, "Oh, this is just a counter trend of that move." I don't really necessarily care. The fact is, it was a counter trend. It wasn't necessarily a correction. It was certainly a trend type move, and that's what I want to guard against, and that's what I want to look and anticipate as a trader is these counter trends. And so there are some clues that the market gives. And I'm big on clues. I'm big on clues to figure out when the market may trend and when the market may counter trend as well. And there's clues in the market that will allow us to anticipate a counter trend. And one those clues is the longer a trend in time and in pips, the more significant is the counter trend potential. So the longer a trend in time, extended trend period that takes a certain amount, a longer period of time that is directional, that is fast, that is moving in a definitive trend to the downside or a trend to the upside. And then the breadth of that, the high to low trading range of that trend, the longer it is, the more significant is the counter trend potential, and that obviously makes logical sense. Obviously, if you have a range of 20 or 30 or 30 big figures, then a correction, a normal correction, may take the encompass 1,000, maybe 1,400 pips, maybe 1,200 pips to the upside. It's only it's simply a mathematical thing to have a correction that would be a percentage, a Fibonacci percentage perhaps of a trend type move. So that allows that is one of the clues that I look for, is a trending market that's been trending for a long time, and also trended for a significant amount of pips. Now you can, I spoke about the daily chart. You can also apply this to hourly charts as well. If you have an hourly trend, that is a significant move that it takes up a certain amount of time. That is, something significant, and also the high to low trading range over that period of time is a good type move as well. And we'll go through some examples later on today, including the current market in the euro versus US dollar. Then you could anticipate or start to anticipate a counter trend. Another clue that I look for to anticipate a counter trend is if a significant trend, a significant move from either high to low or low to high, does not have a correction of at least 38.2 along that trend, excuse me, it is more of a candidate for a counter trend move. So if the trend up or down has not had a normal correction, and I define a normal correction, folks, as the 38.2% retracement, Fibonacci retracement of a trend. If there's no point within that main trend where the market has corrected at least 38.2% retracement, there is a better chance for a counter trend move. And so you start to anticipate these counter trend moves. And the importance of anticipating a counter trend move, folks, is because what you have to do as a trader is retrain your mind to think in terms of the counter trend. By that, what I mean is we all know that the trend is your friend. We can see the market moving down for an extended period of time. You get caught up in that trend. You start thinking in terms of where can this trend go? Where can it go? But if there comes a point where the trend has run its course, if you will, then you have to train your mind to think in terms of where can this counter trend take me? And in fact, the first thing you have to answer is, can we counter trend? And then where can this counter trend take me? And if you understand that, then you can deprogram your mind from a bullish trend to a bearish counter trend. And that's significant. Most retail traders are not able to do that. They're still thinking in terms of a major trend. So when the market starts to counter trend, they're not prepared to, let's say the market is bearish, they're not prepared to buy. They're more prepared to sell a rally. But the smart traders recognize the potential of a counter trend, and they are more inclined to look to trade that counter trend, to take advantage of that counter trend, because it can be significant. We'll get into that and when we look at the charts as well. So when you have the potential for a counter trend, there are a couple things that you need to do that are important in order for you to gear your mind toward trading this counter trend. And the first thing is important to put the potential counter trend into perspective. And by that, what I mean is, how far in pips can the counter trend actually go? And you do this by applying a Fibonacci retracement. So led up to that. I kind of gave a little hint in regard to that earlier by discussing that 38.2% Fibonacci retracement. We'll get to that in a second. When it's all another thing that is important to do when you're in the potential for a counter trend is to put the potential move into a time perspective, And again, I'm going to get into that in just a second. And the final thing that you need to understand when you start to think about trading the counter trend is that it is important to have a reason to trade the counter trend. And if that reason fails, you need to get out. Why? Because trends are fast, trends are directional, and you don't necessarily want to fight the major trend. What you're trying to do is anticipate a counter trend, but that doesn't necessarily mean that it's going to pan out. But if you have a reason, and what I mean by reason is a technical reason to trade the counter trend, then you have a reason to get out of that counter trend, and I'll go through that as well. I've promised you a lot of things here, so let's go into and take a look at some of the charts and to kind of put these ideas that I've told you into perspective from looking at the actual charts and looking at some examples as to what I mean. So let me bring up my chart package here. Hold on a second. I'm going to take the camera off for a second, put up my charts, and I'm going to put on the camera and bring up this euro-dollar chart. Does everyone see the euro on a daily chart here? I'm getting a yes from Harley. Okay, great. I assume that everyone else is, if one person says yes, everyone's saying yes. So what we have here, this is probably the granddaddy of all of moves to the downside, or at least in recent memory here, of the euro versus U.S. dollar. The euro was hit consistently from this high going back to 151.44 was a high that we reached last or November of 2009, and the market trended and trended and trended and trended down, and we reached a low of 118.76 on the June 7th, 2010. Now, the thing about this trend here, and one of the clues that I have in regard to the possibility of a counter trend is to go back in time and look to see what the corrections did at each of the levels along the way. And if you look at this chart and you put the Fibonacci up here at the top at 151.44, and you start to go from correction level to correction level, I want you to pay attention to this 38.2% correction line right here. And remember, I said earlier that if the market doesn't correct more than 38.2% during this trend move to the downside, it's more of a candidate for a counter trend correction, just by the virtue of the fact that it's gone a long way and we haven't had a major correction along the way, and also the time factor of the trend is also of a significance. In this case, the euro dollar trended for a period of about 7 months to the downside, down, 7 straight months with no real pause along the way. So let's take this Fibonacci and let's move ourselves down from each of the corrective lows and see if we get anywhere near 38.2. Now, the first correction actually comes up to 38.2% correction, but that's because we're just at the beginning, and you can see that we went below. This is my 100-day moving average. This is my 200-day moving average. These are the moving averages that I use on a basis here. And what we see here is that at the beginning of the trend, it's not hard to get to 38.2. What I'm looking for, so I often discount that first move. I know there's always these exceptions to the rule, but in this case, I'll always give a free pass order to the first one. But even in this case, the market only went 38.2 and then started to move back down. If you come to the other lows, do we get near the 38.2 line? No, we're not anywhere near that 38.2. When we come to this point right here, this other low right here, do we get anywhere near the 38.2? No. When we come down to this low, do we get anywhere? No. Do we come down to this point? This is a 500 pip correction. Do we get anywhere near 38.2? No. When we come down to this point right here, we don't get anywhere near it. Don't get that low at 118.76, and we don't know where this market may correct, but we can start to think in terms of, well, let's see if there's a reason to think that the market has a potential to correct higher and have a significant correction to the upside, perhaps even a counter trend move. So in analyzing whether this is possible, remember I said you need a reason to do the trade. You need a reason to change your bias off this chart from being so bearish to bullish, and off of things like tools that I use like the moving averages. We're not anywhere near the moving averages at all in this chart. As far as retracements, we know that we're not near the 38.2% retracement. In fact, we're still trending to the downside. Now, there are some other clues here off of this daily chart, which I do want to point out that you could possibly grasp on and think in terms of, well, I have a reason to be bullish, and if I have a reason to be bullish, I also have a reason to exit the trade if the trade doesn't go well. And what I want to point out is this area right here around the 121.50 level. If you look at these lows on this daily chart during this period right here, we can count a number of times. Actually, the low range was 143 to 66 in this range. I'm going to discount this move to the downside. We went to the 11 and we bounced quickly back up to the upside. It was a rejection, a pure rejection of this break of this trend line. But if you look, or this what I call this remembered line. But if you look at this move, you can count 1, 2, 3, 4, 5, 6, 7 different bars here where the market came down to that's around the 121.50 level and had a bounce. So that becomes an important floor for the market. It also, if you were to look at this chart at this point right here, you as a trader are thinking in terms of we're reaching a bottom here. Do we see any other bars, apart from perhaps this area, but it doesn't add up to the amount here, where we've had a bottom? No, there isn't through this whole trend to the downside. So this is a clue that's kind of getting your mind geared toward, maybe we have the potential for a counter trend move. Now what happens here? So traders are buying against this level. Once you have 1, 2, 3, 4, 5, there's a reason to buy against the 121.50 level. Doesn't necessarily mean that reason is going to turn into a counter trend that could possibly head up toward the 131.24 level. No, but it is that possibility. But what we see here is that the possibility goes out the window. The market breaks that 121.50 level, and I'm not surprised that over the next 2 days after that, the market heads down to the 118.76 low. That was the ultimate low for the currency pair. Now what happens after that low is reached is important in analyzing this market as well. You are bearish the market at this point. There is no reason to think that the bias has turned to the upside in this trend. In fact, the idea that maybe the euro is going to parity, which is what they're screaming at this point, is still in play here for the euro versus U.S. dollar. I'm going to ask, can everyone still hear me here? Because I heard a sound that makes me think I'm offline. Yes, okay, good. Okay, we're both good. All right, so let's continue. What we see here, however, in the next few days is that the market, after hitting the low, 1, 2, 3 days later, we're back up testing this what is now the ceiling. It was a floor here. It is now a ceiling. We are testing that 121.50 level, and on this day right here, we get to a high of 121.41. On this day right here, right at the end, we get to a high of 121.52. The market is knocking on that door. It's trying to bottom. It's trying to get back above that 121.50 level. And when the market does move above that level, what does that do for us? That gives us a reason to be long. That gives us a reason to actually think that the euro has bottomed. Why? We had this floor here. We went down. It took 2 days to move to a new low, and 5 days later, we're back above the floor. We define a level that we can buy against, a level that that you can feel confident against, and a level that we can define our risk. If we have a reason to trade above the 121.50 level, we also have a reason to get out of our trade if the market goes below 121.50. So this is an important important thing when you're trading a counter trend, is always have a key reason to do the trade. And this is a key reason to do the trade. We failed on the break to the downside. So look for a key reason. The next thing that you want to do once the low is in place is make sure you put your Fibonacci retracement in and look at where the target is. Where can a counter trend go if the bias remains to the upside? And right at this point, if the price remains above 121.50, where could this go? And when you put a Fibonacci in here and you see 131.24, you automatically think when the market's at 121.50, there's no way this market is going to go to that level. There's no way it's going to make its way all the way up to 131.24. The fundamentals are negative. Greece is going to fault. We're going to have all sorts of issues going on. But we have to remember that currency markets correct themselves, and also things like central banks are there to try to solve problems. If there's going to be a problem in the Greek situation, they're going to try to solve that the best way they can. They're going to demand that there's austerity packages. They're going to give them credit. They're going to allow them some leeway as far as their credit lines go, and all of these things can help contribute to not a change in the trend, just a counter trend type move, a possibility that the market go higher. Now, on this day, am I thinking necessarily that the market can go to 131.24? No, I'm not. Unrealistic. I hated or I disliked the people who are saying that the euro can go to parity from 118. Why? Because that's 18 big figures, folks. It's fantasy to let's get to 115. Let's get to 120. 110. Let's try to move in that direction. And so, am I thinking 131.24 is where we can go? No, but what I am thinking is this: that we've trended for 7 months. We haven't had a 38.2% correction. We have room to the upside that could take us up to this level. If it goes 1/3 of the way to 131.24, that's 325 pips, folks. That's a 325 pip correction or counter trend to the upside. That's if it only goes 1/3 of the way to the 38.2% retracement. There is room for the move to the upside, for the counter trend. And that's an important thing for you as a retail trader to grasp onto, that there is this possibility. Doesn't mean that it's necessarily a certainty, but there is a possibility, a probability that this market, even if it's a 1/3 of a 38.2% retracement, could go 325 pips. That I want to be on that trend. I think you do as well. It's an opportunity to make some money, and besides, your risk is limited to 121, a move below 121.50, maybe to 121.35. So you're only risking a little for the potential of a lot. So how do we see? So what happens in the market? Obviously, the market goes up, and this little move right here is 300 pips, folks. This move from 121.50 up to this high of 124.67 is your 300 pips. This is the 1/3 of this correction to the upside. Is this move right here? This is 1/3 of this whole move to the upside here. And so there is your 300 pips, folks, that you could have had, simply on this idea that I have a reason to trade. I have a possibility to move to the upside. Now, I did skip one thing. There's another thing that I wanted to, that I said in my preamble, if you will, and that was to put the correction in terms of a time. So I'm going to take a little step backwards, and I'm going to give you an idea of what this 131.24 what 131.24 means in terms of what I call a time perspective. And by and this is another important thing that allows you to get your arms around what the possibility of a significant correction to the upside. And what I mean by that is that at the low right here, if you put a Fibonacci in from the high to the low, and you targeted 131.24 as just a normal 38.2% correction of a trend move to the downside here, just a normal blip to the upside that could trend down to the parity level. If you look back in time and look at the last time the market was at that level, I go back to this date right here. This date was May 4th. This low was June 7th. 1 month and a couple days prior to the low that was reached, we traded 131.24. Only 1 month. 1 month ago, the market traded 131.24. If there's any sort of positive news that comes out of the situation out of the Europe, don't you think the market has a possibility of moving up to where the level was 1 month ago, just 4 weeks ago? I think so. I think that is something that I can grasp onto and say, yeah, that is something that could happen. I want to change my mind, change my perception, if I have a reason to think that this could happen. This is a possibility. I want to think about buying. I don't necessarily want to think about selling anymore. I want to trade against the trend and take advantage of a counter trend move. And those are what the smart traders are thinking about. They're not thinking about it going down here. They're thinking about it holding the 121.50 level, and lo and behold, the market comes down. Where do we go to? 121.51. You can go to your charts, take a look at it. And then when the market starts its rally to the upside, we start to get to the move. And where do we go? It takes to August 2nd. The market breaks the 38.2% retracement. We move up to a high of 133.33, and then we correct down. And ironically enough, the correction. Well, actually, let's take a look at this right here. And if we look at this move to the upside, if we discount the first move to the upside, do we have any corrections that move to the 38.2% retracement? No, we don't. So in this case, this move to the upside is and if you see a reason to sell at the highs, there's reason to believe that the market actually has a potential to head down to 38.2% retracement. It does. In fact, it heads down to the 50% retracement and starts to move back to the upside. So that is a lesson in counter trend moves. I'm going to take a few little looks at some of the other charts, like an hourly chart, to kind of show the same type of thing. It's something that you can look at. Here's the euro on the way to the upside. Any move, if you go from high to high, watch 38.2% retracement here. High to high, 38. No, we don't get near. This is probably the biggest correction. Do we get near the 38.2% correction? No, I'll move it up to the high here. Won't cheat here. You can see that we don't get down to the 38.2% correction. We don't get down here. We don't get down here. We don't get down here. We get to this point right here where the market reaches a high. Now there are other tools, of course, that are following along this trend here, and the other tools that I use include the moving averages and the trend lines, and they are going to give us our reason to think that the market has a potential to correct. So if we have this, obviously this trend to the upside, no 38.2% correction along the way, and then you see the top being made here in the chart, which came in at the 133.33 level here in the euro versus US dollar. We have our trend line in place to test the 1, 2. We tested it here. We tested it here. We tested it here. We have that trend line in place. This blue line is our 100-bar moving average. We have that coming in right around the trend line as well. So we have a couple of reasons why the market, a couple of reasons to think of perhaps we have a counter trend potential here, a chance to go to the 38.2% retracement when we're at 133.33, going down 5 big figures. Is that a significant move? It is to me. I am starting to gear up to think in terms of maybe this market, I'm going to change my bias from bullish to bearish. I'm going to think in terms of the market moving lower, and lo and behold, we see the market start to move in the direction to the downside, and it doesn't take but a day or two for the market to head down to 38.2% retracement after breaking these key levels and moving down lower. We find the support at 50%. We continue down. We head all the way down to 61.8% correction on the way to the downside. That's an example in the euro on an hourly chart. A 5-minute chart can do the same thing. We have the euro moving up here. Any sort of correction, we have this spike to the upside on this day. This is the FOMC day. The market, in this case, we don't see any moves towards 38.2% correction level. We finally reach the top right here, and we can, we look for reasons to sell the market at the highs. And one of the reasons would be this two moving averages converging, the price coming together here. We haven't had a 38.2% correction, and the market starts to move down to 38.2 before moving back up to the upside. So, the point is that these opportunities exist in the market in a trending market that trends for an extended period of time. When you see the market trending for an extended period of time, and you don't see a 38.2% correction along that trend, start to train your mind to start thinking about the possibility of a counter trend. And if you can trade the trend and stay on the trend, that's the main goal, folks. But if you can look for those counter trends, look for those opportunities to sell against the trend with a reason, with an understanding of where you can go, with a time perspective of how long ago the market traded at the 38.2% correction, you can start to take advantage of not only the trends, but take advantage of the counter trends as well. So I'll take some questions here. I see one already coming in. How did you make the 121.50 as your support level? Well, that's a good question, forex 81, and I'll actually tell you why the market found support at that 121.50 level. First of all, it could have been a low can be made for any reason, just the fact that the market was selling off rather quickly. But in this case, the euro had key support down below, and I'm going to go to the weekly chart, and I'm going to take a look at this weekly chart because I need to look at a longer term perspective. In fact, let me go. There we go. If you look at the euro dollar on a weekly chart here, forex 81, and people out there, and you do a Fibonacci from the low. This is the low going back to October of 2000. So this is the euro's all-time low, and you move it up to the all-time high in the euro. What you can see here is that the 50% retracement came in at 121.31. 121.31. Let's go to our daily chart. 121.43 was this initial low here on this day right here. 120. That's one. Right there. 121.43. The second day is 121.43. So the market had a reason to trade to have buyers at the 121.31 level, or I think they did. I think the market, the smart traders out there, knew that the 50% retracement came in at the 121.31 level, so they were finding buyers against that level, and they were buying against the 121.31 level, and if the market went below that level, they would stop themselves out, and that's what we saw here in this sharp move to the downside. Support. The low is 41. We went down to 11 on this day, where the market quickly rebounded. We found, it was a test, probably a run in the stops type thing. We broke below the level and quickly rebounded. The next couple of days it started to move down. So that's why there was good support at the 121.51. And then it became its own floor here during this period here. Forget about what happened in the past. That was the initial support here. Then it became support. And then support became resistance. And resistance again became support. And that caused the base to do it. Can you do a live example? Well, let's look at the current market actually in the euro versus U.S. dollar. And this is a good point because, and I meant to get to this, but let's look at what has happened over the last, 3 or 4 weeks. And by the way, I did a webinar on anticipating the trend to the upside here on FX Street Go back in time, look at my series, and sort of kind of anticipated that the market was going to trend to the upside, and lo and behold, we have. But if we go from high to high, let's watch our 38.2. Do we get anywhere near the levels? Actually, let me take this out here. It's getting in the way. And I'll go to our recent chart here, and I'll look at the euro here, and we'll go up, and we'll look at 38.2. Do we get anywhere near 38.2? No. Do we have the conditions in place for a potential counter trend for those people out there? Yes, we do. We do have the conditions in place. If I can get it up here for the potential counter trend. So that's number one. Do we have a reason? Oh my Lord. There we go. Do we have a reason yet to think that we are going to counter trend here in the euro versus U.S. dollar? Let's see. Let's try to find a reason to trade against this counter trend. Put some trend lines here and trying to fit some trend lines in here. Off of the hourly chart here, we don't have a reason off of the 100 bar moving average here. We don't have we may have a reason to sell here, but it's not a key reason. Just like, let's go to the daily chart here and take a look at the daily chart. And I'm going to get rid of this. Oops. Let me get rid of this Fibonacci, that one. And I'm going to take a look at the where we stand off the daily chart. And if you look at the trend to the downside, we broke above the 50% retracement level. I'm going to put a horizontal line across the top here. This is our next target on the top side. This comes in at 136.91. So the high for the day came in at 136.42. So we have resistance against there. Is this a key reason to sell? Not yet. You don't want to necessarily just pick a top and say, okay, we're due for a correction because we haven't had a 38.2% retracement. Where might a key reason to sell be? Off the 5-minute chart, we haven't had a reason yet. This is our 100 and 200 bar moving average. The market is non-trending here. What I can say here, folks, that perhaps you can hang your hat on a little bit is that this trading range for today. We have 136.42 is a high, 135.66 is a low. So that's 34 pips to 36 and 41 pips. So we have a 75 or 76 pip trading range. That's a narrow trading range for the euro versus U.S. dollar. So we're kind of getting into the situation, and the moving averages are moving sideways on the 5-minute chart. So we are getting into a situation here, folks, where the euro is running out of steam, but there is no real definitive reason to necessarily think that the trend, that the bias has turned to the downside. We're above the 100 and 200 bar moving average on the 5-minute chart. We're above the 100-hour moving average on the hourly chart. We're not near. We haven't gotten to this high yet. We're above the 50% retracement. So right now the bias is still to the upside. Now, what a clue might be is if we take out the low here, this should lead to further momentum to the downside here because we're in a narrow trading range. I would expect that the market would extend the trading range to what is more normal, 25, 30 pips. And then we have perhaps a reason to sell from a shorter term perspective in anticipation that a better reason will come off of one of the longer term charts. So that is how I'd look at the market right now. There's really no reason to necessarily sell right now. I don't have a clear, good, key reason to think that the bullishness is over yet. I'll be looking for it because we are in this condition, folks, where we haven't had a significant correction, and the market has trended for 3 weeks now, and the move has taken us over 1,000 pips to the upside. And if we were to have that reason here, that could take the euro down to the 132.60 level. That would be the counter trend target. What's the fib retracement to counter trends usually go? The question is to which fib retracements do counter trends usually go? I'm just because this is we're looking at the longer term trend. We're looking at the longer term trend, and that trend is significant. I don't just do this off of 100 pips or something like that. You have to do it off of a significant trend move. We are in a significant trend to the upside right here. This is significant. 1,000 pips in 3 weeks or so. That is a significant trend move. So it's the first level, the first target would be the 132.60 level. Now, make sure you understand what I say here. It doesn't necessarily mean we're going to go through 132.60. It just allows me to turn my bias from bullish to bearish. If the market should start to move down at this point right here, and we get to this 100, and I have let's say we break through, let's just use this. We break through this low, and I have a reason to sell, and now I'm thinking in terms of, okay, where are we possibly going? I still have to get through this 100-hour moving average. If the market doesn't get through that 100-hour moving average, I can't get to this point right here. So I'm going to have to see this market get through that level. But what this does, what the analysis does, folks, it allows me to be patient with the trade. If I sell at this because of this reason here off the 5-minute chart, and the market comes down to the 100-bar moving average, and I'm anticipating a move possibly to this level right here. I can stand a little correction off the 100-bar moving average because I'm in a good trade location. I'm anticipating a counter trend move. I am going in that direction. I hear you, Sean. And the potential exists that we may come to the 100, correct up a little bit, and then continue the momentum to the downside because the bias is more thinking in terms of the counter trend rather than what is the trend now. So I hope that makes sense to you as an answer. But the important thing is to change your perception from trend to possibly counter trend and where we could go in that counter trend because we haven't had a correction in a long while. So I've got to wrap it up. I appreciate everyone coming out here today. If you do have any questions, you can send them to me although I'm on vacation this week, folks, but I'm doing this on my own time. At Greg at fxdd.com. If you want to, I do webinars. Sean and I do webinars and webinars, and we do daily commentary. If you want to be part of that commentary, email distribution and be part of our webinars, just send us an email at greg at fxdd.com. Actually, send it to Sean Powell at fxdd.com. That's his email address. I didn't mean Sean Powell. I meant spowell at fxdd.com. And he will be happy to put you on the email distribution list. As I said, I'm taking a little break here, finishing up my book at home, so I won't be back until Monday. But I thank the people at FX Street. I thank you people for coming out, and I wish you all the best and good fortune in your trading.